All right, let's go ahead and get started. Good afternoon, everyone, and happy Veterans Day. So to all my fellow veterans who may be watching right now, thank you for your service. For those who don't know, my name is Lee Reiners, and I am the Executive Director of the Global Financial Markets Center here at Duke Law School. And we are extremely fortunate to be joined by our distinguished guest today, Chris Giancarlo, who really needs no introduction, I'm sure, especially to those who follow the cryptocurrency space. For formality's sake, Chris is senior counsel at the international law firm Wilkie Farr and Gallagher. Prior to his current role, Chris served as the 13th chairman of the U.S. Commodity Futures Trading Commission, or CFTC, where he oversaw regulation of the futures, options, and swaps derivatives markets. As I'm sure most of you are aware, while at the CFTC, Chris earned the nickname CryptoDad for his celebrated call on Congress to respect a new generation's interest in cryptocurrency, an experience he details in his excellent new book, CryptoDad, The Fight for the Future of Money. I should also note that Chris is the co-founder of the Digital Dollar Project, which promotes research into a US central bank digital currency, and he talks about this experience as well towards the end of his book. In terms of format, we will reserve the last 15 minutes for audience questions, and I will encourage you at that time to put your questions into the Q&A function here in Zoom, and I will be sure to flag them. So with that, Chris, congratulations on the book. I really enjoyed it, and thank you so much for being with us today.
Lee, it's great to be with you. It's fitting that we're here on Veterans Day to talk about what I call the fight for the future of money. But I'm looking forward to today's conversation, so it's great to be with you.
Absolutely. So, the book is primarily dedicated to, as you just said, the future of money, cryptocurrency, blockchain technology, and we'll spend most of our time today discussing those issues. But of course, the CFTC has a broader remit, and I'm sure when you joined as a commissioner back in 2014, you didn't think that sort of crypto and Bitcoin would be your legacy. So, just curious to hear, when you came on board first as a commissioner, what were your initial priorities?
It's such a sort of parable for life, and that is, you go to you proceed into one direction thinking you're going to with a big plan to attack that, and other things happen, right? I went to the CFTC to focus on completing the swaps reforms in Title VII of the Dodd-Frank Act, which was a supporter of, and as I said then and I say today, I think Congress got right. But in a number of respects, I actually think the CFTC was misapplying those provisions, and so I was quite vocal about that. And to the great credit of the Obama administration, they asked me to serve and didn't ask me to stifle my criticism, but to just do so in a professional way. And I worked very well with my colleagues at the CFTC, was clear about where I stood about how to go about implementing those, and spent the first 2.5 years of my 5-year term there largely focused on swaps reform and other matters that I detail in the book. But of course, as I say, life comes along. Bitcoin Rally 1.0 happened in 2017, just as I was getting settled in as chairman of the agency. And as we'll talk about, I mean, the rest is kind of, for me, at least history as to how we responded to that enormous new innovation. And it's what, people talk about what sent you down the Bitcoin rabbit hole, what sent you down the cryptocurrency rabbit hole. It was Bitcoin Rally 1.0 and the application of some of our large exchanges to launch Bitcoin futures that sent me down the rabbit hole. But as I detail in my book, I've been looking at this during the course of that decade in different ways, first blockchain technology and then some of the early emergence of crypto. So it wasn't all of a sudden, but it was, gradually and then suddenly.
Yeah, and so Bitcoin Rally 1.0, as you just said, occurred in 2017. That was also the year that you were elevated to chairman of the CFTC after Donald Trump became president. So just curious, Chris, to hear your level of familiarity with crypto and blockchain, prior to that point. Is it something you had studied? I mean, you have a rich history in automated trading markets. So you're a lawyer by training, but of course you have a lot of tech experience. So just curious, what was your first exposure to cryptocurrency and what were your initial thoughts?
Yeah, so just I'm a 1984 graduate of Vanderbilt Law School. I spent the first decade and a half practicing law in New York and London, and in the year 2000, accepted an offer from some entrepreneurs that were building the first electronic trading platforms for over-the-counter derivatives, swaps. And during the course of the 2000s, we grew that firm very rapidly to where it had operations in 18 major financial cities around the world. We took the company public in 2005 in a very successful IPO and then secondary offering in 2006. By 2008, we had grown into the world's largest trading venue, a marketplace for market makers in a type of swap called a credit default swap. We probably saw 80% of the world's credit default swaps trading on our platforms. Now, we were not a trader, we were the marketplace where traders conducted their operations. In the lead up to the failure of Lehman Brothers in the late summer of 2008, we were seeing minute by minute the deteriorating credit quality of our world's largest financial institutions. And I recount in the book receiving a call from the New York Federal Reserve saying, we remember meeting you at a cocktail reception at the New York Fed. So remind us, what is it you guys do again? And I said, well, we actually oversee about 80% of the marketplace for credit default swaps. He said, right, that's what I seem to recall from our conversation at dinner. So what are you seeing in the market? And I said, well, it's 2 p.m. When you say, what am I seeing? What am I seeing now? What did I see at 8 o'clock this morning? What do I expect to see tonight? Because it's so dynamic, it could change any minute. But right now, Lehman Brothers is trading at, say, 800 basis points over treasuries, which basically meant its credit, the perception that it would default on its credit obligations was heightened. The market perceived that it was close to failure. And the person I was speaking to said, wow, that's absolutely fascinating. And after a lot more questions, he said, can you swing around the bank and talk to some of the directors about what you're seeing? And I said, I can't. We have pandemonium right now on the broking floor, but maybe by 8 or 9 o'clock tonight, I can come by. And he said, oh, no, I'll be gone by then. I'm way too busy. I think I got a soccer match for my kids tonight. Why don't we put a date in the diary for like October or November, and we'll have a conversation. And of course, it would have all been over by then. 3 days later, Lehman Brothers collapsed. I had a number of eureka moments at this point. One is I actually became then and remain today a supporter of the core elements of Title VII of Dodd-Frank, that there should be greater regulatory transparency in the market. It just is not good enough that in the middle of a crisis, I'm getting a call saying, what is it you guys do again, right? That's not a long-term solution. Secondly, that to the extent appropriate, more of the instruments should be in central clearing, so you have proper margining and proper collateral management. And then thirdly, that the process that we operated of transacting this should be a licensed activities, just as broking stocks and equities are licensed activities, so it should be this. And that's what made it into Title VII. And in 2010, I put out a statement commending President Obama and Congress for passage of the law. And it was a few years later that the Obama administration remembered that, and I got a call, would I serve at the CFTC? But more importantly, Lee, I had another moment, and that is that it was believed at the time that Lehman Brothers fell that the gross outstanding amount of credit protection written on Lehman Brothers was about 400 billion. And from that, the Fed and Treasury extrapolated that if it was 400 billion on Lehman, then it must be 800 billion on Goldman. And if it's 800 billion on Goldman, it must be 1.2 trillion on JP Morgan. And therefore, they felt, wow, we need a TARP program to basically flood these banks with cash to buttress their balance sheets. But we now know, through research done by the CFTC, that the net amount of exposure of Lehman Brothers was not 400 billion, it was 9 billion. If we knew in 2008 that the way to backstop a failure of Lehman Brothers was 9 billion, that check could have been written out of cash by the Fed. And I'm not saying that would have been the right choice, but that policy choice would have been available. The policy choice was not available because in the fog of war, we had no way of knowing the net position. And as I started to learn about blockchain technology, distributed ledger technology, I realized that if all of those CDS, credit default swap transactions, were on a blockchain across the entire scope of Wall Street and the global banking system, regulators would have that precision understanding of the exposure of one bank to another bank into the financial system. So I started becoming a fan of blockchain technology, started reading about it. And when I went to the CFTC, I brought that interest. In 2014, December 2014, Chairman Tim Massid, in testimony before Congress, started talking about Bitcoin and where it should sit in the regulatory landscape. And he started talking about distributed ledger technology. And in 2015, in September 2015, while now I'm on the commission, the commission, with bipartisan support, took action in a case called the coin flip case to declare Bitcoin a commodity subject to CFTC jurisdiction. And really, it was the beginning. It was 2014, 2015 was the beginning when I really started digging into crypto and distributed ledger technology and the Satoshi white paper. And we were coming out of the big Silk Road, what I call the Silk Road stink that hung over the entire, and the Obama administration quite rightly took some very strong action out of the Department of Justice against some of the purveyors of that. But beyond that was the fundamental technical aspects of this that really fascinated me. And I thought, as much as it is a challenge to the system, it's potentially also a solution to the system. And that drives everything that I believe, both at the CFTC and today and tomorrow, that too often we look at only the shortcomings of this new innovation and our fears about it. We're not sufficiently open-minded, I think, enough to its potential to modernize what is effectively a creaky, slow, exclusive, expensive, rent-seeking financial system. And I think my biggest criticism of a lot of people that look at this is they too much look at the downside, don't look enough at the upside to address the shortcomings of our existing financial and regulatory structure when it comes to crypto.
And that touches on your regulatory philosophy, Chris, which you touch on in the book quite a bit and really guided a lot of your decision making. I think anyone in your position who sort of takes the helm at a regulatory agency generally comes in with some type of overarching philosophy. And so yours was, and I'm quoting here, first, do no harm. So can you just explain kind of what that means and how that guided you when it came to critical decisions, especially around cryptocurrency?
Yeah, so it really comes from a speech I gave at the Cato Institute in 2016 about blockchain technology, and I said that regulators need to address the emergence of distributed ledger technology in financial markets the same way the federal government, in a very bipartisan approach to the first wave of the Internet of Information in the 1990s, under the Clinton White House and the Gingrich Congress, adopted a first do no harm. They told regulators basically, let's not screw this up because this could empower a next generation of the U.S. economy, and it did. I mean, it was the foresight that said this is a way to actually develop a new generation of wealth creation, of economic development, economic growth, turned out to be true. And so I was proposing the same. But whether it's an overarching approach to my entire mandate at the CFTC, perhaps true. I mean, I would say that my overarching approach to technology generally is it's like an unstoppable wind. It's going to happen, and therefore you can either try to hide from it, you can try to hunker down and say let it pass over us and affect others, or you can do what I think we've traditionally done in this country, and that is harness it. Right? Technology is neutral. It's going to have a bad side. It's going to have a good side. I think it's the job of regulators not to try to stifle it or hide from it, but to hitch a sail and ride it and channel it for its best uses and try to prepare for its worst applications. And so whether it was cryptocurrency or swaps or derivatives, I mean, my overall approach is how do we not pretend it's not happening, but how do we prepare for it? How do we get ahead of it? How do we understand it? That's why I created Lab CFTC, specifically because I arrived at the agency and I realized there was no center within the agency that was actually preparing for the coming digitization of markets, for the digitization of commodities. It was clear to me, as an agency that has historically looked over derivatives of commodities, that we're soon going to have digital commodities and we needed to prepare for derivatives on them. And so it's a different, I guess my philosophy is ride the wind, don't try to hide from the wind.
Ride the wind. I'm pretty sure there's probably a song out there titled "Ride the Wind." Um, well, Chris, I want to talk about Bitcoin futures because there's a number of what I'll call pivotal moments in the evolution of the crypto sector. Of course, the most pivotal is the Satoshi white paper, released Halloween 2008. You've already touched on one, which is the CFTC's decision in the coin flip case, which was the first time that the CFTC recognized Bitcoin specifically as a commodity. And then another pivotal moment was the launch of Bitcoin futures contracts in 2017. And I believe there were three contracts. The two kind of most that got the most attention were the Chicago Mercantile Exchange contract and the CBOE contract. So can you just talk a little bit about the role that the CFTC played in the development of these Bitcoin futures contracts?
Yeah, so there wasn't a lot of surprises there. In 2016, I believe, the Chicago Mercantile Exchange created an index of spot prices in the spot Bitcoin market. And you create an index because someday you may want to use that index as a basis for a derivative. And so, with that in mind, we started anticipating this was coming. I took the helm as acting chairman of the CFTC in January 2017 and immediately started planning the creation of something called Lab CFTC, which we launched in May of 2017. And my first instruction to Lab CFTC was learn everything you can about Bitcoin and some of the other key cryptos, because I anticipate soon we are going to face formal applications for products there. And by the summer of 2017, this is true, we were actually conducting synthetic Bitcoin mining operations in the chairman's boardroom at the CFTC with fellow commissioners across the aisle to start familiarizing ourselves with some of the fundamentals of Bitcoin. And we were getting weekly briefings. So every Friday, there's a briefing of a basket of commodity derivatives at the CFTC. We added crypto to that basket the point is that we were quickly getting up to speed, anticipating that things were coming. I don't remember the exact date, but sometime in June and July, Chicago Board Options Exchange, CBOE, approached the CFTC with a self-certification for a Bitcoin future. And we let them know right from the beginning, look, we're going to work with you, but we're going to understand this thoroughly before this happens. And in the fourth quarter of that year, CME announced that they were also going to launch a product, as did the Cantor Exchange. So we had three different self-certifications before us, and when we really worked it quite hard, and I detail this in my book, the approach we did. Now, there were some objectors. I talk in my book about being in Asia in October or so, when a full-page ad appeared in the Wall Street Journal addressed to me from the chairman of Interactive Brokers saying, please don't do this. If you do this, there'll be thunder and lightning and danger to the global economy. And the Futures Industry Association wrote to me, and I received calls from overseas regulators, and it was actually one call from a continental European regulator, a national regulator, that said to me, if you do this, you're legitimizing Bitcoin. And that really struck a chord, because I thought to myself, who am I, an unelected bureaucrat, to legitimize or not legitimize something that is legal to be traded? It's not for me. It's for the marketplace. to legitimize something. If you believe in democracy, if you believe in crowdfunding, if you believe in that it's for a market to determine the value of something, not for an unelected bureaucrat, um, I just felt that was the wrong approach. At the end of the day, and this is the decision we made. It's we have a long tradition of letting markets work out the value proposition of any asset class, and the CFTC's got a very proud tradition. Between the year 2000 and 2017, the CFTC had greenlighted over 12,000 new products. That's more new products that were greenlighted on the rest of the world's market regulators combined. And yet, probably out of that 12,000, I'll bet you 900 of them are still not in operation anymore. Because the approach is, let's let the market work out whether there's any utility to this. And if there is, it will continue. If there's not, it usually disappears pretty quick. And so I actually think that's a very enlightened approach. And so, look, we did our fundamental analysis on Bitcoin futures. We followed our statute. And the statute actually gives, it's very different than the CFTC. The SEC. The CFTC doesn't actually have the authority to approve new products. The exchanges, which are licensed self-regulatory organizations, are the ones who have the responsibility to do various utility analyses, et cetera, et cetera. They certify to us that those products meet core principles. And unless there's a reason to believe that there's a falsehood in their statement, then the commission's job is to basically get comfortable with it and let it go forward. And that's what we did. And I think the last 4 years have justified our decision. This market has grown tremendously. You've got enormous institutional engagement in the market. It is increasingly setting the global price. The United States dollar is underpinned by many strong foundations: a stable economy, free trade, but it's also underpinned by the fact that most of the world's key commodities are priced here in the United States, and they're priced in dollars. Copper, iron ore, energy commodities, interest rates are priced in dollars. That's a tremendous strength. And at the time of greenlighting this, I thought to myself, if Bitcoin is the new digital gold, how advantageous would it be for the United States to have the price set in U.S. markets in dollars? And so I think that's increasingly turning out to be the case. And I felt then, and I feel today that the right decision was made not to find a way to artificially block the launch of Bitcoin futures.
Well, Chris, I want to explore this Bitcoin futures decision a little more, because I'm also one of the critics, and I think I mentioned that to you, so it's not a complete shock.
Oh, I read your criticism at the time, Lee.
Oh, okay, wow. I didn't know that. Well, thank you for not mentioning that previously. So, I think, Chris, you mentioned the self-certification process. It's something that I, frankly, had not been familiar with, prior to Bitcoin futures. It does really limit the CFTC's role, as you said. Futures exchanges are allowed to list new products, 1 day after they attest to the CFTC that they've reviewed it. It complies with CFTC rules and regulations. And I think that's a fine process for most new derivatives contracts, which are probably just kind of slight modifications, perhaps on previous ones. So I think one of the critiques, and I don't think there's anything that you necessarily could have done about this, which is that for something that's sort of fundamentally new, like Bitcoin, there should have been a more sort of robust review process with input from the public and other stakeholders. And I know that was something that the Futures Industry Association said, and we maybe we'll touch on that. But
yeah, let's take that. I want to hear your second part, but I also want to address that one because there's a lot in there.
Yeah, for sure. But in terms of the actual rules and regulations that the exchanges are attesting to, one of them is core principle number 3, which says that a contract listed on a designated contract market shall not be susceptible to manipulation. And so when you review the history, the written testimony of the CFTC's decision making around this, it's very clear that you and your staff were not all that concerned around manipulation in the underlying market. And I think there was pretty clear evidence that back in 2017, there was a lot of fraud and manipulation in the Bitcoin spot market. And that you were concerned exclusively with the ability of the contract itself to be manipulated. And a lot of your dialogue with CME and CBOE was around the reference rate, the index, to make sure that that couldn't be manipulated. So I guess my question for you, and this is sort of something that I go back and forth on quite a bit, is it possible to construct a derivatives contract that cannot be manipulated or is not likely to be manipulated when that contract is based on an underlying that is ripe with manipulation? How did you think about that?
Yeah, that's a great question. So first of all, it's a fine line, but it needs to be elucidated that the CFTC does not have um, the right to say to police the underlying market for manipulation unless it can show a linkage between that and manipulation that takes place in the derivative market. When the CFTC was created, Congress was very clear that CFTC does not have authority in underlying spot markets. Why is that? Because if you have gold derivatives regulated by the CFTC, you don't want the CFTC regulating jewelry stores that are the spot market for gold, right? You don't want the CFTC regulating grain elevators where wheat is sold by farmers to elevator operators. You want them regulating the wheat derivative markets. So unless there's a linkage between underlying fraud in the spot market and therefore susceptibility of fraud of the derivative market, the CFTC can't go there. Our exchange operators are very sophisticated at creating these benchmark models, and CME and CBOE's structure for how they gathered information. So they use various cycles during the trading day where they gather spot information in a very sophisticated way that makes it very hard to manipulate the underlying market to affect the derivative market. And I could spend a lot of technical time going through how they use 6-minute increments over the course of an hour set and then another hour set that's moving, so that it's almost mathematically impossible for somebody to do old-fashioned techniques of banging the close and others to affect the underlying derivative market. So our technical experts at the CFTC satisfied the concerns of the commission that the structure that the CME and CBOE were using were not, quote unquote, as the statute provides, readily susceptible to manipulation at the derivatives level. We're not naive. There may be some degree of fraud that takes place or manipulation takes place in spot markets around the world. But the CME's data is only drawn by a few US-based exchanges, and we were satisfied with the way they were then mixing it together was not resulting in manipulation. However, it's not one and done. You don't do this analysis and then say green light and then everybody goes home and stops looking at it. We structured our what we called heightened review with CME so that we can continuously test whether there was susceptibility to manipulation from the day of launch on into the future. And over the course of my remaining term, which was another year and a half, we got regular reports as to how robust was the functioning of that index and whether there was any indication that underlying market activity was influencing. So I felt very comfortable with that. I do, Lee, want to turn to the other point that the Futures Industry Association wrote a letter. They didn't actually object to the launch of Bitcoin futures. What they objected to was that there was not a hearing process for public input. The bottom line, Lee, was that was not a prudential concern of theirs. It was a commercial concern. They were upset that the world's largest banks hadn't got enough notice from the exchanges to be ready on day one to bring their clients in the market. And they were angry that a few of high-speed brokers were ready to go, and yet the big banks were not ready to go. This was a commercial fight between big publicly traded Wall Street banks and big publicly traded exchanges. And, as someone who worked on Wall Street, wasn't born yesterday, I always was very careful as chairman of the agency not to get dragged into catfights between big giants on Wall Street and in Chicago. And that's what that was. That was a fight between industry players. They were not worried about the little guy. They didn't want to have hearings so that, quite frankly, so that academics could write papers and all that. What they wanted was to buy time for Wall Street to get ready to go. And you know what? If the statute said that there's a time frame that you need to wait for public hearings, we would have done it. But the statute provides that it gives the emphasis to the exchanges. It was written to give them the initiative, and the exchanges said we don't need to do public hearings, and we can force this on 24 hours notice. And at the end of the day, I said nothing's to stop hearings after it launches, but I can't suddenly insert that there needs to be hearings when the statute doesn't provide for hearings. So I did add, though, an additional element, and I wrote about this after the fact, and I said that in future self-certifications, we will ask the exchanges, have they done enough to poll their members? We will do it as an informational request, but I can't actually, unless our rules were rewritten, I can't say to them, you can't launch until you've conducted a public hearing.
That makes sense. And I think, one of the other things you discussed in the book, Chris, that gave you and the agency greater comfort around allowing these contracts to come to market was the surveillance sharing agreements that CME and CBOE had entered into with spot crypto exchanges. And in turn, they were passing this information on to you. And of course, this gets to your broader trend of, improving the data capabilities, making the CFTC a data forward regulator.
And raising the margins, 10 times over standard margins in the industry as well.
Sure.
We took 7 major steps that hadn't been done for a lot of self-certifications that were unique to crypto to give us a better handle on this going forward.
Curious to hear if this data from the surveillance sharing agreements, has that been helpful? Is there any evidence that has actually led to CFTC enforcement actions?
So I can't and won't speak to specific cases, while I was at the agency or may have matured after I left the agency. I will say that we worked that data quite hard. We were publicly critical of some of the data that we were promised, that the quality of it when it came in. And we were working with the exchanges continuously during the remainder of my term to improve the quality of that data. One of the things that I initiated at the agency was some of the first artificial intelligence, machine learning capabilities so we can analyze that data. And I hope that that's continued under my successors, because the better the quality of the data sets, the better the quality of the analytics tools, the more we may be able to use that data in enforcement action. But that was certainly its purpose, Lee. That's certainly its purpose. Although I can't speak to specific cases, the quality of the data and the quality of the analysis was steadily improving over the remaining 16 months of my tenure at the agency.
That's great. So, curious, just the reactions you were getting from your fellow financial regulators, around this, because you're out there, you're sort of forward thinking, leaning into crypto, so to speak. You touch a little bit on this in your book. What were you hearing from Treasury Secretary Mnuchin, Janet Yellen, Jay Powell? What were your foreign counterparts? What was the reaction like there?
So first of all, it was a range. I believe, and after 5 years in government, I'm convinced there is no R or D assigned to people's comfort level with technology. It's across the board. Sometimes it's more of a generational issue, comfort level, than it is a political issue.
Sure.
And I think you see that today. And because the Trump administration had really no policy with regard to crypto, it was kind of left to each agency to approach, to respond to the rise of crypto in a way that was native to their industry's culture, to their industry's tradition, and their leadership. And I'm someone who's always seeing technology for its opportunities. And so, as I've said before, I saw this as an opportunity for the agency to move forward. I also felt it was very much in the DNA of the CFTC to welcome this innovation, but put the right context, the right controls, the right analysis around it. In my book, I detail a lot of conversations with Secretary Mnuchin. I think readers might find some of those fairly humorous. I knew I had the authority, along with my fellow commissioners at the CFTC, to make our decision that we made. But I also worked hard to make sure that where we were going was communicated to my fellow regulators. I never received a no from any of them, but probably in the back of their minds, some of them may have thought, I wish this would happen some other time. That
this guy's crazy.
Yeah. But that's okay. I mean, I've been called crazy many times. I can live with that. I talk in my book about sort of a way of thinking about this. I kind of believe that you can almost anticipate the response to crypto. Where you stand is based upon where you sit,
Yep.
And so for market regulators around the world, the sophisticated market regulators in major market centers like Singapore or Hong Kong or London, the reaction was, this is another tradable asset. As long as we can make sure that we've got a basis to look for fraud manipulation, that we've got a proper regulatory regime, we can get comfortable with it. The second category would be, I think, sort of island financial economies or offshore financial economies. They may actually be onshore, like in the case of Switzerland, or they may be offshore, like the case of Singapore. But economies whose wealth is built upon looking after assets were pretty welcoming to crypto as a new asset class to be preserved and protected. Switzerland, Singapore. And then continental global economies with a reserve currency are the ones that are most skeptical of this. Why? Because they see it as a potential threat to their reserve currency status. And I think using that shorthand, you can almost anticipate the regulatory response looking around the world. Even China today sees their response to the rise of crypto as an opportunity to rise their own national currency into reserve currency status by making it the world's first true digital currency. Other economies, I think they're in a fight or flight moment with this. But anyway, that's the shorthand, and
Sure.
I started perceiving that during my time at the commission, and I think that kind of shorthand way of looking at it holds true today.
Well, I definitely want to save time for a central bank digital currency question or two. But one of your other fellow regulators, Jay Clayton, had maybe a different approach, I'll say, but driven by the agency's mandate. I think there was an expectation, Chris, as you're well aware, that after Bitcoin futures came to market, that was just going to be a matter of time before there was a Bitcoin ETF, either an ETF that tracked underlying Bitcoin, or an ETF that tracked Bitcoin futures. And in fact, we didn't get any of that until just a few weeks ago, when we have now the first ETF tracking Bitcoin futures. And I think Jay Clayton received a lot of criticism from folks in the crypto sector for his refusal to permit a Bitcoin ETF. So can you just talk about kind of how you perceived his thought process around this? Because you're very clear in the book that you two actually did see eye to eye on a lot of issues. And so, maybe this is kind of one of those things from the outside looking in. It's like a manufactured controversy. But what's your perception there in terms of how the SEC handled this?
It's actually fascinating, right? At the surface level, the perception of the CFTC was crypto positive. At a surface level, the perception of the Jay Clayton SEC was crypto negative. But at a different level, we were actually motivated by very similar instincts, which was to preserve the integrity of the regulatory framework that we were sworn to uphold. In the case of the CFTC, a long tradition of greenlighting the launch of new innovative products. And let me actually take a moment and talk about the birth of the CFTC. Up until the 1970s, the major marketplace for managing economic risk was commodity derivatives, whether it was on olive paste in ancient Greece all the way up to wheat futures in the Chicago markets. a huge American innovation breakthrough was the creation of financial futures by a few Chicago visionaries like Leo Melamed and Doc Sandor in the 1970s. This was such a powerful innovation that they actually went to Washington and with the support of the federal government received authorization to create a new regulator, the CFTC, to oversee this new innovation to make sure it succeeded. And so the CFTC's DNA is born of greenlighting new financial innovation. Financial innovation, by the way, that probably created two generations of extraordinary wealth for the United States. It allowed the United States to go off the gold standard. You couldn't have done it if you didn't have interest rate futures. It allowed the United States to go off the gold standard, and it made the dollar to replace gold as the world's benchmark. All of that was through American innovation, and those innovators worked with the official sector of the United States to create a brand new regulator to oversee that innovation. And think about that in the light of a new innovation today, how remarkable that is. So I'm very conscious as the 13th chairman of this agency of that tradition of promoting US innovation that benefits the US economy. Clayton comes in and he steps in the shoes of the venerable Securities Exchange Commission created in the 1930s to oversee the world's most important equity markets, capital formation markets, with two fundamental principles. One is disclosure, adequacy of disclosure. Second one is registering with the agency the offering of securities. And what does he see? And by the way, Jay Clayton, like me, didn't go to the SEC to work on crypto. He went to the SEC, hopefully, to work with their accredited investor standards that basically protects investors by protecting them from investing in some of the best and most promising innovations. So he went to try to open that up a little bit. And what did he find? He found the ICO, initial coin offering, explosion of thousands of these ICOs. And he had to step up and protect the framework of SEC structure, which is that disclosure and registration regime. So he found himself having to basically machine gun down all these ICOs to uphold the framework of the SEC's regulatory structure. I found myself greenlighting Bitcoin futures in order to uphold the innovation structure of the CFTC structure. So we're, as we joked the night before a hearing from the Senate Banking Committee, I said, Jay, either you're a jackass and I'm a goat, or I'm a goat and a jackass, depending on whose point of view it is. One way or the other, we're going to get slaughtered tomorrow in this Senate banking hearing. But we both came out of it to uphold the framework, a venerable framework that served the United States very, very well for many, many decades.
So we're approaching the final 15 minutes. I want to encourage folks to start putting their questions into the Q&A function here. We already have a few that I'll get to shortly, but Chris could talk to you forever about some of the crypto decisions that were made at the CFTC. But I want to make sure we have time to discuss some more recent policy developments, and I want to start with the release last week of a report on stable coins. This was released by the Presidential Working Group on Financial Markets, which consists of the Treasury Secretary, the Fed Chair, the CFTC Chair, and I think in this instance, they're joined by the Chair of the FDIC and the Comptroller of the currency. I'm sure most folks are familiar with what stable coins are. If you're not, they're just digital assets that are designed to maintain a stable value, generally pegged to the US dollar. What were your impressions here, Chris, on their recommendations, which were, for those who don't know, to essentially bring stablecoin issuers into the national banking system and require them to become depository institutions? Initial impressions, and I guess, how would you regulate stablecoins?
I was quite disappointed in it, quite frankly. 30 years ago, the official sector in the United States took a first do no harm approach to the first wave of the internet of information. Since then, we've seen the Internet of Things, and now we're in the third wave, what some people call Web 3.0. I like to refer to as the Internet of Value, or the Internet of Money. This time around, the official sector's response is first protect the incumbents. And that's how I read this statement. Incumbents both in the financial market structure, banks and other large financial institutions, but also protect the regulators. there's not even a hint in that report that regulators need to change a single thing about what they're doing. It's okay, we're good. We don't need to change anything in the wave of this innovation. The innovation needs to satisfy our concerns. It's innovate to regulatory comfort. It's not move regulators out of their comfort zone to anticipate how this new innovation could actually bring positive change. The truth of the matter is, the United States dominates the existing legacy financial system, and it was a great financial system in the 20th century, just like many of our bridges and tunnels and airports were state of the art in the 20th century. But time has moved on, and these systems haven't modernized. Our existing financial system is highly exclusive. It requires identity in every case. And if you're one of the 1.5 billion people in this world today that do not have, out of 8 billion, that do not have identity, you can't fully participate in our financial system. It's expensive, it's slow, and it features a lot of rent collection. The fact that you can send a text or an email or a photograph around the world in a second at virtually no cost, and yet it costs 1 or 2% of the world's GDP to just move money around the world, is an outrage, quite frankly. It costs 17% in some cases to remit money from some of our most vulnerable populations that are working away from home in order to send money home to their families. And so we can do better if we're willing to see the upside of this innovation and not just the downside. And yet this report was all about the downside. It was all about regulators need to do nothing to change. Innovation needs to satisfy regulatory concerns. Regulators really, according to this report, don't really need to do anything other than sit back and say, come on and see us, and try to fit into our 1930s statutes and our 1950s, actually 1940s court cases. I was disappointed in the report. It didn't bespeak of a modernizing impulse. It didn't bespeak of a national interest in modernizing our financial system. I was disappointed in it.
Well, speaking of a modernizing impulse, you are the founder of the Digital Dollar Project, which advocates for the U.S. to step up its game in exploring the use of a central bank digital currency. This is something that many countries are actively exploring. I think, as you already touched on, China has rolled out in a pilot phase a digital currency of their own. So just tell us more, Chris, about the Digital Dollar Project, what it is trying to do, and the prospects as you see them for a U.S. digital dollar.
Yeah, thank you for that, Lee. So along my journey down the crypto rabbit hole after greenlighting Bitcoin futures and really doubling on my study and my thinking on this, I'm convinced that within the next 10 years, every major central bank in the world will launch some form of a central bank digital currency, or will authorize private sector issuers of an authorized central bank digital currency. But money is going digital. There's no question in my mind that money will return to a tokenized form in a digital fashion. And China's leading the way on this, as you note, but 3/5 of the world's major central banks are looking at this now actively, including some of the United States' major global economic competitors, in some case, economic adversaries. In my book, I talk about the 7 reasons that I've identified why I think that every major central bank will pursue this. The first one is data capture. That's certainly what got China focused on this initially. The success of Alipay and WeChat Pay as a payment system in China got the PBOC and the Communist Party focused. If anybody's going to own that economic data of Chinese citizens, it's going to be the central party. But it wasn't just totalitarian governments. Our own government in the United States and in Europe, as they saw Facebook's plans for its Project Libra, now Diem, got concerned about who's going to own that economic data. And quite frankly, I'll come to it in a minute, that may be one of the most important concerns for private citizens. Just briefly, the second reason is infrastructure modernization. Third is financial inclusion, precision monetary policy, the enormous success of stablecoins, basically edging into the government's monopoly on wholesale payments and the private sector's correspondent banking's monopoly on retail payments. And then geopolitical influence. And then finally, and this is why we launched the Digital Dollar Project, what values are going to be encoded in the digital future of money? I say in my book, so money is as much a social construct as it is a government construct. And I say in my book, I took a line from the French premier Georges Clemenceau, who said looking back on the carnage of World War I, he said, "War is too important to be left to the generals." And I feel as we go into a digital future of money, money is too important to be left to central bankers. The public has a right to demand that the future of digital money protects their privacy, protects their economic liberty, and is not subject to censorship by either big technology firms or big government. And we cannot sit back and just assume that privacy rights will be protected in a digital dollar or a digital euro or a digital pound. We know they won't be protected in a digital yuan, which will be used as part of China's social credit system. And the ability to have visibility into people's financial transactions may be too much for many central banks to not gravitate to. And so a free society needs to speak up. And we formed the Digital Dollar Project to be a voice, not an exclusive voice necessarily, but a voice for what those values will be in the future of money. And it's a concern, and it's part of the reason I wrote my book. I tell a lot of fun stories in it. I recount what we did at the CFTC, but ultimately, I wrote my book not for people inside the Beltway, not for crypto enthusiasts, but for the bookkeeper down the block and the dentist I visit once a year, to say to them, you've got a stake in the future of money. And if you value economic privacy, and I'm not talking for illicit conduct, but for private conduct, then we've all got to speak up and let our central bankers and our governments know that digital money is coming, but don't fool us thinking that the convenience of it will blind us to the loss of our economic liberty or our economic privacy. That must be equally sacrosanct to a well-functioning digital monetary system.
Well said. So with that, Chris, I want to get to some of the audience questions. And again, if you have questions, feel free to put them in the chat. So I'm going to combine or just throw two at you, both of them from Joseph. The first is he wants you to put your market prognosticator hat on, and he asks, when will we see a spot Bitcoin ETF? The other, he asked about your thoughts on Bitcoin in El Salvador being legal tender. So whatever order you want to take those, Chris.
Sure. The second one, just the short answer is, I think I wouldn't use their adoption of Bitcoin as a herald of national adoptions. Those are two very unique economies with major structural shortcomings, and they're hopeful that these will address some of their domestic currency problems. I don't think that's much of a harbinger of what major economies will do. I think it's an interesting one, but I wouldn't put a lot of stake in it. On Bitcoin spot, I think before we get there, we actually need to look at perhaps, I'd like to see Bitcoin ETFs on physically settled Bitcoin futures, which are offered by BACT, which is the part of the Intercontinental Exchange. You know, there are two, in most commodity futures markets, there's two types of derivatives. There's cash settled, dollar settled, or there's physically settled. As you do in many commodity markets, you actually have to deliver the wheat at the end of the 30-day period or deliver the oil. And so we do actually have physically settled Bitcoin futures, and I think that would actually provide some market diversity alongside the cash settled ones that we actually have on offering. I just don't see the SEC getting comfortable with spot Bitcoin, but it is possible that we do have US-based spot trading platforms that perhaps could provide a function for that. I'd like to see that. I will tell you that when I was at the CFTC, once we went live with Bitcoin futures, we anticipated that Bitcoin ETFs would come potentially based on the markets that we were overseeing. And we immediately started thinking about what that would mean. How would we manage margins? What would we do in terms of position limits and what the impact of that? We had done a lot of research into that prior to my departure in 2019. I can only hope that a lot of that research was viewed and considered as the SEC went forward with its green lighting of the ETFs. And there's a lot the agencies do. Sometimes I'm critical of policy, but I'm never critical of the agencies themselves. There are so many good and talented people at the CFTC and the SEC that do really brilliant analysis. And there was really good work we did at the CFTC preparing for and subsequent to the launch of Bitcoin futures. I'm sure the same is true at the SEC. And I'm sure, and the exchanges as well. I mean, they've got some of the best analysts going. So there's a lot of good people pulling for orderly markets. I'd like to see Bitcoin spot ETFs on spot develop in time because I think that will help balance the ETF market, but I can't tell you when that will be.
So next question comes from Ryan Clements. So he asked Chris, how does widespread CBDC take-up affect the private digital currency market? So isn't a CBDC really just a response to the demonetizing potential or a large network take-up of a stablecoin like Libra? He also asked, going back to the President's Working Group report, he wants to know, are you concerned about stablecoin reserves such as commercial paper and shadow fractional reserve banking?
So to the first, it's a great series of questions. My mind is spinning.
Yeah, so let me just ask, I'll just ask you the first one. I'll break it up here.
Yeah.
So isn't a CBDC just a response to the demonetizing potential or a large network take-up of a payment stablecoin like Libra?
Yeah, it is a response to that. Unquestionably, it's the same response that the federal government did to state-issued money during the Civil War. And it's the same response that forced the central government to create the Federal Reserve System in the early 1900s and eventually monopolize the issuance of fiat money. So yes, I mean central banks. So it's almost always the private sector that leads with innovation, and regulators and central banks follow. But don't underestimate the desire of central banks to maintain certain monopolies on monetary policy and monetary tools. And it's part of the reason why I think within 10 years, most central banks will roll out central bank digital currency. Now, in my book, I actually put forward the hope that when we create a digital dollar, we don't actually get rid of non-sovereign digital money. For one reason, I think the central bank's got a lot to learn from the 10-year, 12-year now experiment with non-sovereign digital money. But two, I think our rights as citizens in a free society are best protected if we have choice, right? I think if anybody has a monopoly, if Facebook had a monopoly over money, you can bet they're going to suck every bit of information out of that because that's how they operate, right?
Yeah.
And I can even see that neutrally. I'm just saying it. It's just a fact.
Yeah.
But I'm not convinced if our U.S. government had a monopoly on it, they wouldn't do the same. Just 3 weeks ago, there was a proposal to monitor all transactions of $600 or more. So why would they not? And so maybe our best protection is being able to have what I call in my book a jigsaw approach to money. I may choose to use Facebook's DM on transactions I want public. I'm a musician. When I'm wasting time on my computer, I look at guitars, and sometimes I buy one. If they want to have that information and give me a discount the next time I buy a guitar, buy my information. But if I want to give to a controversial cause, I actually may want to use a government money that respects our Fourth Amendment privacy protections, if they do protect it, or another service that does. So I think the best way we can protect our rights as free citizens might be competition. I'm worried about monopolies over money, whoever owns the monopoly, sovereign or non-sovereign.
Oh, we have time for one more here. And it flows nicely here because it's around Fourth Amendment protections, and it comes from Robert, who clearly read your book, Chris, and he wants to hear more about the anecdote that you provide in the book around you fighting to protect the source code of stateside automated trading firms without and the CFTC apparently was asking for this source code without a subpoena. Under what you denote as Fourth Amendment protection. So can you just provide a final take on that?
So if you get me your email address, I'll actually send you the transcript of the CFTC hearing where I voiced a very strong dissent, and I was outvoted. But the next week, the Wall Street Journal did a piece actually commending and fortunately that policy was put out as a proposal. It actually never saw the light of day, but it would have given the CFTC the right to take and retain the source code of proprietary trading firms in the marketplace without a subpoena. And look, the subpoena right goes back to medieval England. It's ingrained in constitutional democratic societies as a basis for protection between the governed and the government. And without the subpoena rights, government can willy-nilly take things. There should be some independent arbiter of whether there is probable cause for the government to take your property. And so I argued that it was a tense hearing. I think we eventually, for that time at least, won it, and it became a foreshadowing of some of the very issues I'm worried about today. I began this conversation today with Lee talking about how I look at technology for what the opportunities are. And I think digital money of the future can provide much greater financial inclusion, lower cost, lower rent-seeking behavior, turbocharge economies to greater wealth creation, greater efficiency, a greater standard of living for all of our fellow citizens. But the underside of that is, what are we giving up? We've all enjoyed the convenience of digital commerce, of a new digital economy, but we're too relaxed about giving up our information. You like something 200 times, they know no more about you than your spouse does. We've got to be very careful to not accept the conveniences of digital money and sacrifice our economic liberty. I'm a great believer in liberty and freedom of religion, freedom of conscience, freedom of speech are enshrined in our Constitution. But in a capitalist economy, your economic choices say as much about you as all those other things. Economic liberty is as fundamental, I believe, to a free society as every other liberty, and we've got to safeguard it dramatically. And that's why, part of the reason we started the Digital Dollar Project, to make sure the free society has a voice in what I think will ultimately be digital money. We've got to make sure free people speak up and make sure their rights are secure in doing it.
Well, that is a great note to end on. Chris, we can't thank you enough for your time today. We really appreciate it. And again, I recommend the book, CryptoDad, The Fight for the Future of Money. It's a great read. And I'm not just saying that because Chris is here. I really do enjoy it. So Chris, thank you.
Thank you, Lee. Thank you, everybody.
Take care. Thanks, everyone.